There is a lot happening on the regulatory front right now, and I think what makes this moment particularly interesting is that the SEC is really challenging the current public company requirements in the United States. So let's get into it. If you look at the rulemaking table on this slide, what stands out is both the volume and the pace of activity from the SEC in the first half of 2026. In a few months, the Commission has issued an interpretive release, a final rule, and 3 separate proposals, all touching different but interconnected aspects of how public companies operate and access capital markets. The March 17th interpretive release on crypto assets was a joint effort with the CFTC and marks a real pivot away from the previous Commission's approach. Then in May, we saw a flurry of activity, starting with a long-awaited semi-annual reporting proposal, which dropped on May 5th. On May 18th, the SEC finalized a rule rescinding its prior policy on enforcement settlement denials. We'll come back to what that means in practice. And on May 19th, 2 significant proposed rules came out simultaneously, one on registered offering reform and one expanding EGC accommodations and simplifying filer status. Each of these deserves its own discussion, so let's take them one at a time. The interpretive release on crypto assets is one of the more consequential regulatory shifts in this space. It's not just about crypto. It reflects a broader philosophical change in how the SEC approaches regulation. To understand why this matters, you have to appreciate the frustration that has been building in the industry around what many called regulation by enforcement. Under the prior approach, the SEC was effectively applying the Howey test, the classic securities law framework, retroactively to crypto asset transactions that had already occurred. Companies and issuers had very little advanced clarity on whether a given asset would be treated as a security. This interpretive release, issued jointly with the CFTC, attempts to clarify what should be considered a security. Generally, digital commodities, digital collectibles, and digital tools are not considered securities. Let me explain what those are. Under the guidance, a crypto asset qualifies as a digital commodity and therefore falls outside the securities framework if its value is derived from a functional crypto system and from supply and demand, rather than from the managerial efforts of others. That definition in practice captures most cryptocurrencies that you know. Bitcoin, ETH, Solana are examples. In addition, crypto assets that are designed to be collected, or if it represents a right to artwork, music, trading cards, examples of these are CryptoPunks or fan tokens, and those are considered collectibles. Digital tools include crypto assets that perform a practical function, such as Ethereum named service domain names. In addition, there was clarification of blockchain activities that would not need to be registered with the SEC. Transactions such as protocol mining activities, protocol staking activities, offer and sale of a staking receipt token that is a receipt for a non-security crypto asset not subject to an investment contract. That last one's important because what does not change is if you take a traditional security, a stock, a bond, and tokenize it on the blockchain, it remains a security. The blockchain wrapper doesn't transform the underlying instrument. For companies in this space, the takeaway is that you now have more guidance to work with, but the analysis is still fact-specific. You still want to apply this criteria carefully to your particular facts and circumstances and document that analysis thoroughly. And also, as a disclaimer, you should always consult with legal counsel to ensure compliance with federal securities law. Now, what is on to arguably the most exciting proposal of the year? Semi-annual reporting. On May 5th, the SEC proposed allowing public companies to shift from quarterly reporting to semi-annual reporting using a new form called the 10S. The quarterly reporting regime has been a fixture of U.S. capital markets for decades. Critics have long argued that it creates excessive short-termism, meaning that companies manage to the quarter rather than create long-term value. Proponents counter that quarterly disclosure is a fundamental investor protection mechanism that keeps markets informed and limits insider trading. This debate is not new, but what is new is that we're actually seeing a rule related to this. The comment period is currently open and will be open until July 6th. If you want to get in there, you can expect a significant volume of letters from all sides. Audit firms, investor advocates, issuers, and preparers have a lot at stake here. The proposed rule would apply to registrants that currently file the Form 10Q, regardless of filer status or size. as well as to companies filing initial registration statements that would become subject to Form 10Q reporting requirements. However, the SEC is requesting comments on whether the eligibility for semi-annual reporting should be limited to certain categories of registrants, such as emerging growth companies or smaller reporting companies. Also note that this would be an election that a company can make, not a requirement. The 10S would mimic the existing requirements of Form 10Q, and sorry to disappoint everyone, but it would still be subject to XBRL tagging. In addition, disclosure of non-GAAP measures would continue to be subject to the SEC's requirements related to the non-GAAP measures. Related to controls, the proposal would maintain the existing framework for CEO and CFO certifications and for internal control over financial reporting, ICFR, that applies to all annual and interim reports, allowing semi-annual reporters to make required certifications semi-annually rather than quarterly. Chairman Atkins released a statement with the semi-annual reporting release and described this as the first step of a larger, comprehensive effort to review and reshape the rules governing public companies, covering both their ongoing reporting obligations and their ability to raise capital. He explicitly said that over the coming months, the Commission expects to consider a series of proposals that, taken together, would redefine what it means to be a public company and make being public attractive again. That last phrase is worth pausing on. The number of public companies in the US has declined significantly over the past 2 decades. The SEC appears to be responding directly to that trend. For those of you advising companies that are considering going public or are already public and managing compliance costs, this broader deregulation direction is worth watching closely. I know I have a lot of clients that are excited about this.